You mentioned on Twitter recently, I think it was this week or maybe last week, that you're noticing financial market liquidity is turning. You referenced a couple of currency pairs that are popular with more of the trading community for signaling inflections in financial market liquidity or economic growth. So tell me what you're seeing there. Why is financial market liquidity turning, and what does it mean for the Fed, for the economy, and for, let's say, risk assets?
Yeah, when you're thinking about financial markets, there is the steps that central banks take to, tighten or ease liquidity conditions and monetary policy and interest rates. And then there is somewhat necessarily a private sector response to that set of conditions and all the other things that are going on. And so if you've sort of been around the business long enough, you sort of get this feel of, when a combination of central bank behaviors plus what the private sector is willing to do, if that is picking up, more positive, you could say more positive, let's say, financing conditions or financial conditions. Liquidity is confusing because I think there's people have specific definitions of liquidity, which I don't want to get into. A little bit of a buzzword. Yeah, it's kind of a buzzword. I kind of think about it like if you just take the effect on financial conditions from what the central banks are doing and what the private sector is doing, and you put those two things together, when that is expanding, certain, that the money and credit essentially flows to corners, sort of the outer edges of the market, and those assets do particularly well. So, Bitcoin or high yield spreads or really high beta emerging markets, right? Those are sort of the corners that you see do well when that's expanding. And then when it's contracting, those corners of the market don't do well, right? They're the first ones to feel a bit of the tightening effects of financial conditions, whereas sometimes you actually see the core of risky assets do well because capital is moving from the riskiest to the core, right? So you might see the S&P 500, like if you go back as an example in the financial crisis days, like you actually saw like the U.S. kind of do well, the sort of core of the U.S. do well, even though the sort of periphery of the global financial market started to show some tremors during that period. And so
all the way through the first quarter of 2008.
Yeah, exactly. Right. Through the first quarter of 2008, even though we were on the cusp of the greatest financial crisis in 100 years, right? Right. And so I don't think I'm not claiming that we're going to have a repeat of that.
I almost got you.
You almost got me to say it, but not quite. And in these circumstances, if you've been through these circumstances before, what will end up happening is people will look at this thing and that other thing, and they'll say, oh, that's idiosyncratic because of an election in Mexico. And that's idiosyncratic because, China's data is a bit soft and they're implementing some housing policy. And that, and what people will do is all of them will say there's some idiosyncratic thing going on in all these things. But when you look across all of them, if you're sort of seeing it show up everywhere, it tells you there's something bigger afoot than a bunch of idiosyncratic things. And I think that's what we're seeing. I don't, as a simple example, like I don't trade Bitcoin as an asset. I don't understand it well enough to feel like I have alpha to generate in it. But I think there's a lot of smart people who have worked on it, who connect its movements to liquidity dynamics. In sort of the same way that I think about liquidity dynamics. And you're seeing those assets sell off. You're seeing like the riskiest coins sell off. You're seeing Bitcoin sell off. You're seeing emerging markets sell off. You're seeing continued pressure on the yen. You're seeing the crappier stocks in the U.S. index, fall despite the fact the S&P 500 is rising. Like those are all indications that this set of financial conditions is starting to constrict, and that if the Chinese currency is going down and the yen's going down and Bitcoin's going down, it doesn't really matter for the economy. But if that starts to affect the core, like the S&P 500, then that can have a meaningful impact on the wealth effect, balance sheets, et cetera, and that can create a more significant dynamic. And so, could it just be quarter end, balance sheet cleanup, which, you always have to be careful about? That often happens. Or is it just that things are a little thinner with, these 2 weeks with, the holiday last week and the holiday next week, that we're kind of seeing where the sort of cracks are in the global financial conditions story? I'm 50-50, but it's certainly, everything is not hunky-dory here. And, tales of stocks going to, astronomical heights certainly is not aligned with this sort of tightening of financial conditions that we're seeing across financial markets today.